there's some clearly, recovery which is there from the lowest point of the day. But let's see how things move. Keki Mistry is joining us, Vice Chairman and CEO at HDFC. Mr. Mistry, good morning. Thanks a lot for joining us. Now, before we talk about your company, for industry, clearly real estate market has seen a big bounce back over the last 6 months or so. Do you reckon for housing finance companies, the next 6 months, 12 months could be really good in terms of a bit of a bounce back?
Well, if you ask me, Anuj, the cycle has changed and changed in a significant manner. And it's not just been in the last 6 months, it's been there for nearly over a year, actually over a year. I would say this momentum started in October 2020. And every month after that, what we are seeing, at least in our business, is that our individual loan disbursements are going higher and higher month after month. So we did see a period between 2018 and 19 when the residential real estate market, particularly in the metros, was a little weak. But that now seems to be behind us, and there are several reasons for that. One is affordability has improved and improved significantly. And this is by virtue of the fact that between 2018 and 19, property prices didn't move up, but income levels consistently kept rising. And therefore, housing has become a lot more affordable today than what it used to be in the past. This is one reason. Second is this fear that there was so much of oversupply in the market, which was prevalent in that 2018-19 period, has gone away. So people now realize that there is not that much oversupply. So I think a combination of all these facts, coupled with the structural demand that we believe we will continue seeing in India, has pushed the growth to very strong levels. And we see this across the board. We see this in metros. We see this in non-metros. So earlier, the engine was really firing from the non-metros. Now it is coming all over the country.
Mr. Mistry, hi, good morning. Would this mean acceleration of growth compared to what we've seen for the 9-month period? Or, I mean, basically, are you calling for continuation of the same trend?
Well, we have seen acceleration of growth quarter after quarter. If you take, for example, the period October to December of 2021, we had a 20% growth in approvals. Now, you have to remember that October to December of 2020, the previous year, had a very high base, because that was the period when the stamp duty cut was prevalent in Maharashtra and in a couple of other states. So despite that strong base, the growth was still very strong. And we continue seeing that momentum as we post the close of the quarter. I don't want to get into numbers, but the momentum has continued unabated. And my sense is the way things look now, it should continue for a very long time.
Okay. All right, Mr. Mistry, the non-individual loan book, well, that's not seen that great growth. I get your point. You were just telling us that individual has been doing very, very well. But what about the non-individual? Last few quarters have been a bit of a dampener. Do you see demand coming back now?
Absolutely. So let me answer that. Our individual loan book increased by 16% year on year as of December. And if you go by the RBI numbers, the growth of housing loans in the banking system was 9.3%. So clearly, we've grown a lot faster than other players, by and large. This is one. But when you come to non-individuals, non-individual business has 3 components. One is construction finance, which is currently 9% of our book. Second is lease rental discounting, which is 7% of our book. And the third is corporate loans, which is 5%. Now, in the construction finance segment, the period of 2018-19, which, as I said earlier, was a period when there was some stress in the real estate market, particularly in the metros, we did not see the launch of too many projects. Now, a construction finance loan, unlike a lease rental discounting loan, the disbursement for a construction loan happens slowly, gradually over a period of time. It's not done in one stroke. So, for example, if you have a lease rental discounting loan, the property is ready, the property has been leased out, and you just make one disbursement and the loan appears in your balance sheet. But in a construction finance loan, the disbursement is linked to the stage of construction. So as the developer keeps constructing and spending money, we would also keep disbursing money to him. So the disbursements come over a longer time frame. Now, we have seen a very sharp pickup in the demand even for construction finance, simply because of the fact that in 18-19, there was a slowdown in real estate, not too many projects were launched. But since 2020, with the pickup in demand in the residential market, a lot more projects have got launched. But disbursement for these projects is now happening gradually quarter after quarter. So my sense is you will see a pickup in the non-individual book also in the quarters ahead.
Okay, so Mr. Mistry, the interest rates clearly have bottomed out and they are on a rise. So what's the guidance on the margins? So last quarter was 3.6%. How do you see that play out?
See, we have, Anuj, lived through various periods of time over the last so many years where interest rates have gone up and interest rates have come down. And if you see our spreads have always remained stable. So I don't believe that there would be any impact on margins or spread either positively or negatively if interest rates go up. Having said that, you must remember one thing, that we have about 1.15 trillion rupees of shareholders' funds. Now, on this 1.15 trillion, there is no accounting cost. There is no interest cost debited to the profit and loss account. But the income that we earn on this 1.15 trillion would be dependent upon the interest rates in the economy. So if interest rates actually rise, it has a beneficial impact as far as the net interest margin is concerned. So my sense is spreads would remain stable. Net interest margin, as rates rise, could have a tendency of moving up.
Mr. Mistry, with the RBI relaxing the rule regarding the daily stamping of NPAs, could you tell us how your need for provisioning will change in the fourth quarter and beyond?
We don't. I'd spoken to you on your program earlier on also. I don't see any change in the provisioning requirement because we've been extremely proactive with our provisioning. The RBI change is only something where you can will you call a loan a non-performing loan or not call a non-performing loan. To my mind, the risk associated with that loan does not increase significantly. So I don't see it having a material impact on provision. And we, as I said earlier, have been more than adequately provided. We have provided ahead of schedule in the expectation that as the economic activity picks up, which what we are seeing, the credit costs over a period of time will actually start declining and not increasing. I don't want to get into quarterly numbers, but my sense would be that over the next 2-3 years, you should see credit costs revert back to the levels that used to prevail pre-2017-18, which was around 15 to 20 basis points. Whereas at this moment for the current year, the annualized credit cost is 35 basis points. And last year was a little over 50 basis points. So that number will keep declining.
Okay, all right. Mr. Mistry, if you could give us a sense, where are you seeing maximum demand traction? Is it in the luxury? Is it in mid-income? Is it in the affordable segment? Or, if you could give us some color on that.
All right. So the demand is coming all over the country. The demand is coming both in the affordable housing segment as in the high income market. To give you a sense of an average loan amount, last year our average loan amount would have been around between 27 and 28 lakh rupees. This year, our average loan amount in the first 9 months has been 32.3 lakhs. So the average loan amount has gone up. Now, the increase in the average loan amount reflects an increase of demand in the metros. So obviously prices of property in a Mumbai or a Delhi or a Bangalore will obviously be a lot higher than the prices that you would see in a tier 2 or a tier 3 town. So as demand picks up in the metros and as demand has picked up over the last 1 year, the average loan amount has kept rising. So to answer your question, it is pan-India across all segments, but the luxury market or the higher income market, which was slow a couple of years ago, that has started seeing a sharp pickup, resulting in the average loan amount going higher.
Okay, all right, Mr. Mistry, thanks so much for stopping by. You're sounding extremely buoyant about demand going ahead. We wish you well, and we appreciate you joining us and, in fact, giving us your quick insight. For the time being, though, the Nifty continues to remain under some pressure. We're down by close to around 450 points odd. They were close to around 65 points off the low point of the day. Can we hold on to those levels? Well, that's going to be extremely crucial. For the time being, we'll slip into a short break, but on the other side, we'll get an exclusive conversation going with the Secretary of Ministry of Road Transport and Highway. Later on, Ekta Batra will join us to take us through the upcoming launch of Remdesivir, that's the generic by Indian pharma companies. To discuss the same, we'll also connect with a couple of analysts. You stay with us.
A vision